Gambling is, gonna have more risk associated with it, worse economics overall from a tax perspective. And, the risk is going to be in considerations around the netting of profits and losses and some of the considerations that go into that. Capital treatment, where, you're going to treat this as property, but it's not 56. And it's less conservative than an ordinary treatment overall, but I would say more conservative than Section 1256 treatment. Section 1256 treatment is usually the most attractive to taxpayers, but it's also unsettled. It's not clear if these contracts fit into Section 1256, and there's going to be a high burden that you as a taxpayer have to clear to substantiate that tax position. So let's first get a bit into gambling. So under this framework, gains are ordinary income, losses are itemized and deductible to the extent of winnings. And, this framework is most commonly argued for sports contracts, or it most neatly fits into sports contracts because, they most closely resemble gambling and a wager. This gambling tax treatment becomes weaker from a tax perspective for other types of contracts, such as macroeconomic contracts or political contracts, especially if they're taking place on a CFTC regulated exchange. Importantly, beginning in 2026, gambling losses are capped to 90% of winnings. So that means that, a trader that may break even for the year still can owe tax on income that was not economically realized. So, gambling is one of the treatments that's considered, but you can see it doesn't necessarily clearly map to all contracts, and it has some deep considerations from a tax perspective. And, the loss netting is one of the more complicated areas of this. And